Hey everyone, welcome back to the channel. Today we read diving into one of the most powerful and underrated strategies in long-term investing, dividend growth investing. If you want to build wealth over time and earn growing passive income, this is a strategy worth understanding. Dividend growth investing is exactly what it sounds like. Investing in companies that not only pay dividends, but increase those dividends consistently over time, instead of chasing high yields. Dividend growth investors focus on quality companies with a proven track record of raising their dividend payouts year after year. These businesses might not pay the highest dividends today, but their dividends grow steadily, often outpacing inflation and growing your income as the years go by. So why go for dividend growth instead of high yield? Reason 1. Long-term compounding. Growing dividends mean more money reinvested back into your portfolio. Over time, this creates a powerful compounding effect. Reason 2. Inflation protection. Your income grows over time, helping you keep pace with inflation. Unlike fixed income investments, dividend growth gives you a rising income stream. Reason 3. Company strength. Companies that consistently raise dividends usually have strong cash flow, healthy balance sheets, and shareholder-friendly management. All signs of quality. Reason 4. Emotional discipline. When markets get rocky, regular and rising dividend payments can keep you calm and invested. Let's break down what to look for when hunting for great dividend growth stocks. 1. Dividend growth history. Look for companies with at least 5 to 10 years of consistent dividend increases. Bonus points if they've kept raising dividends during economic downturns. 2. Payout ratio. This tells you what percentage of earnings are paid out as dividends. Lower ratios below 60% suggest room for future growth and lower risk of cuts. 3. Earnings growth. A company can't raise dividends without growing profits. Look for consistent earnings per share, EPS growth over time. 4. Industry stability. Companies in recession-resistant sectors like healthcare, consumer staples, or utilities tend to be reliable dividend growers. 5. Strong balance sheet. Low debt and high return on equity ROE can signal financial strength and the ability to keep growing dividends. Let's go over a few dividend growth strategies you can use depending on your goals and risk tolerance. Strategy 1. Core dividend growth portfolio. Build a portfolio of well-known stable companies with a long dividend growth history. Think Apple, Johnson & Johnson, McDonald's, or ASX-listed stocks like CSL or Wesfarmers. Goal: steady income growth plus long-term capital appreciation. Strategy 2. Blended growth plus yield approach. Mix moderate yield with high dividend growth. For example, pair companies like Procter & Gamble, lower yield, steady growth, with something like Telstra or Transurban, higher yield, slower growth. Goal: balance income now and income growth later. Strategy 3. Drip and chill. Reinvest your dividends automatically through a DRIP, dividend reinvestment plan. This buys more shares every time dividends are paid, compounding your returns. Goal: maximize compounding over decades with minimal effort. Strategy 4. Dividend growth ETFs. Not into stock picking? No worries. ETFs like VIG Vanguard Dividend Appreciation US, or VHY Vanguard High Yield Australia focus on companies with growing dividends. Goal: instant diversification and hands-off investing. Dividend growth investing is powerful, but it's not bulletproof. Let's talk about a few risks and rookie mistakes. 1. Overpaying for growth. Even great dividend growers can be overvalued. Pay attention to valuation metrics like PE ratios and growth expectations. 2. Ignoring business fundamentals. Some investors get too focused on the dividend and forget to watch the actual business. Always invest in companies with solid financials. 3. Lack of diversification. Don't load up on one sector, like just banks or utilities. Spread across different industries for stability. For assuming growth will always continue, just because a company has raised its dividend doesn't mean it will. Stay updated with earnings reports and company news. Dividend growth investing isn't flashy. It's not about overnight riches. But it's a proven strategy for long-term wealth, rising passive income, and staying invested through thick and thin. If you've got value from this video, give it a thumbs up and subscribe for more investing strategies just like this. And tell me in the comments, what's your favorite dividend growth stock or ETF? I read every one. Catch you in the next one? And remember, consistency beats hype every time. As always, hit that like and subscribe, and happy investing.